Hi, welcome everybody to our Tobias Financial Advisors first quarter 2022 market update and outlook webinar. We would like to welcome everybody today. Those of us that can join us, we are thrilled to have you here today. Before we dive into the nuts and bolts of our presentation, we do want to remind everybody that this is a general educational session and that any topics covered here today are our thoughts and views, but we counsel individual clients and counsel 401k plans, so it's really up to your unique situation as to how you should be invested. And so if you have any questions or comments about your portfolio or things that you're seeing in the economy, please do reach out to your advisor here at Tobias Financial Advisors. We also have some new folks that are joining us today. We hope that you reach out to us as well to take a look at your portfolio as well. So my name is Matt Sainholtz. I'm the Chief Investment Officer here at Tobias Financial Advisors. I've been with the firm for over 15 years, and I am a certified financial planner and a chartered financial analyst, a CFA. Chad is joining us today as a CFA as well. There's only about 170,000 of us in the world today, and it's really proud to have that designation because it's kind of like a master's in finance. It takes 3 or 4 years of hard study to achieve that designation, and it makes really in-depth knowledge of portfolio construction. So Chad, welcome today.
Thank you so much. Really happy to be on here. Just a little background on me. I'm Chad Neesmith, the trader and portfolio analyst at Tobias Financial. I joined a little bit over a year ago, moving down from Atlanta, Georgia. I went to college at Kennesaw State University, born and raised in Georgia. I'm an avid golf fan, so I really enjoyed the Masters a few weeks ago, and it's really gotten me itching to go out and play some golf. But other than that, I really appreciate your time today, and thank you everyone for joining.
Great. Tobias Financial Advisors, who we are. We were founded in 1980 as an accounting firm, and then transitioned into personal financial planning the late 1980s, early 1990s. Today, we work with all different types of clients and families, small business owners, 401k plans, and we're managing over $600 million currently for these types of entities and individuals. What we really value here is education. We've already mentioned our chartered financial analyst. We do have a CPA on our team. We have someone who's designated to speak to business owners about exit planning. And so we really value just education and going to conferences and keeping up with today's current trends. So that's what we're here to do, and that's what we are attempting to do for all of our clients. Before we dive into what's been going on in the markets, we kind of just want to do a high level about what we're trying to achieve for our clients. So that really is developing a portfolio that will meet clients' needs and help you achieve your goals, living the lives that you want. Depending on how much risk you're willing or needing to take in your portfolio, we structure a portfolio that is diversified across the globe. Various different asset classes, between bonds, fixed income, which we'll be talking about a lot today, as well as your traditional thoughts of investing, which are the stock market and different companies around the globe. One thing that we do that we really value and adds a lot to our after-tax portfolio returns is thinking about taxes, thinking about how to reduce cost in your portfolio, and kind of taking advantage of different types of retirement accounts that is offered today here by the IRS. Maybe that's a Roth IRA, maybe it's a traditional 401k, SEP IRA, all these different types of things that as you file your tax return, we try to help mitigate your taxes so you can have a better approach to your investing as well as your tax picture as well. So today's agenda, we're going to cover kind of what happened in the previous quarter and talk about some returns, and then also talk about what's hot in the markets and in the news today, market volatility, inflation, and also kind of the outlook in regards to Ukraine versus Russia and some geopolitical tensions out there. So we want to cover that today. And I'll first start by reviewing the first quarter of 2022. Wow, all red, Chad.
Yeah, we couldn't escape the red this quarter.
No, we couldn't. So all negative returns. What you're looking at here on the left is kind of different stock portfolios with the S&P 500 here in the U.S., international developed markets, that's kind of Asia, Europe, Japan, and then emerging markets, as well as global real estate. All negative numbers and returns ranging from -4 to negative almost 7%. That's on the stock side of things. On the bond side of things, with interest rates increasing, the value of our bonds or fixed income portfolios were also down in that 4 to 5% range. This is what the markets have done, not necessarily our portfolios, but this is what the markets have done overall in the first quarter. I was thinking about the S&P 500 and the U.S. stock markets, and this is the first negative quarter since COVID started, really. First negative quarter since the first quarter of 2020. So it's been a couple of years since we've had a quarter that ended in a negative fashion. And as long-term investors, we do know that this is going to happen from time to time, and we do have to take it in stride. It's kind of interesting to also note that whether you're just because stocks were down and bonds were down at the same time, no matter where you kind of are or what type of portfolio in on the risk spectrum, you likely experience some level of negative returns, because if you're an aggressive portfolio, typically we think of that as more stocks in the portfolio, your stocks were down. And then vice versa, where when we think of more of a conservative portfolio, things that are invested in the bond market and fixed income, we don't have so much stock exposure, those were also down as well. Now, we've done some different things in our portfolios to mitigate some of these negative returns, and we're going to cover some of that moving forward here. But you can see it's just kind of a negative quarter with really nowhere to hide, depending on where you're invested. Now, when we look at, like I just mentioned, across the globe and different types of asset classes, this chart showing various things you could have invested in the past quarter and various returns. So if you look at the top, crude oil is up 33%, and Brazil was up 35% in the past quarter. Both kind of interconnected. Of course, Ukraine, Russia and invasion kind of led the oil markets up to as high as $125 a barrel in that first quarter here recently. But it's back down to 100 around there today, which is kind of a positive outlook for us. And U.S. is not going to survive on $200 a barrel of oil, but we've been there before with $100 a barrel in oil. So that's okay. And Brazil in itself was coming off a really low negative year due to some political events, and they're also kind of tied to the oil markets as well. So that's what's been coming up leading the quarter. But as you can see, everything's kind of bunched in the middle there between -4 and -7%. And this is stocks around the world, big companies, small companies. When you get down to specific countries, China was one of the least performing asset classes in the first quarter. China's actually had a pretty big resurgence of COVID, and so they've chosen to lock down some of their economy. It's led to a lot of negative returns and some negative economic outlook in that economy. But as you can see, it was a tough quarter, and we will kind of review what we think about what's ahead and what are some of the topics that we are thinking about as we're looking forward into 2022. So Chad, if you could give us a little bit of insight onto market volatility.
Of course, yeah. We have a really nice slide coming up. This is the S&P 500 historical returns and the intra-year drops in the calendar year. So for example, if we're looking at this year, the far right of your screen, you're going to see a -13%. That is from top to bottom, how big the pullback was at the very top of the market to the very bottom of the market. As you can see, we've rallied some off of the very bottom of the market. This chart really hammers in how important long-term investing is, because you don't know how deep the valleys can be. We can still end up on the year. And if you were looking at this year as a -13%, if you were to go back the last 42 years, the average is down 14% for the average intra-year return. So what we've experienced, even though it's war and a lot of political uncertainty, geopolitical risk, inflation, it's an average year so far as intra-year pullbacks. So it's something that we're paying close attention to. But again, you never know when you can get a big up year if it's really down. So the most recent example of that is COVID in 2020. If you were to look to your left just a little bit from the 13, you'll see the down 34%. That's the COVID year, and we ended up 16% that year in returns. And some may think that that's some kind of a, doesn't happen very often, but it also happens. It happened last again in 2009 was an extreme example of that. We were down at one point 28%, ended up 23% on the year. So those are two really good examples of how selling at the bottom would really hurt your portfolio, because most of the time the market is up and it ends up at the end of the year. So the last 32 out of 42 years, as I said earlier, about 75% of the time it's positive. But we're going to talk a little bit about interest rates in the next slide and bond portfolios. That was stocks. So now bond portfolios, if we're looking at fixed income, on the right side of your screen, you're going to see what's called a yield curve on U.S. Treasuries. This is something we look at. I look at it almost every day when I'm looking at interest rates, because interest rates control the prices of all financial assets. And then the Treasury yield curve is the base case. It's kind of the discount rate for all financial assets across the world. And what we started, you'll see two different curves right here. If you're going to the far right side of your screen, that's going to be tied to the 30-year Treasury. So that 1.9, it went up to 2.81. So from the beginning of the year to last week, April 13th, it went up almost 1%. And as you go left, it gets shorter in maturities. So one key rate people pay attention to very often is a 10-year Treasury. It increased from 1.52 to 2.7 year to date, which is an extraordinary move in just 3 months, or a little bit over 3 months. And even in the last week, as we speak about it today, it's trading at about 2.91. So in the last week, it's gone up another, 20 basis points. So that's 0.2% or almost 1/4% in an increase. Now, when you look at the yield curve, the far left side of the screen is the very short end of the yield curve. That's tied to what's called the Federal Reserve. If you hear in the news of Federal Reserve increasing interest rates, they're almost always talking about the very short end of the yield curve. That's what the Fed funds rate is tied to, and we will expect that to increase, and we'll cover that a little bit more in some future slides. We expect that to go up through this year, but the yield curve has gone up, and it's brought down all bonds, all stocks with it. It's put a lot of pressure on everything, really. And if you look on the left side of your screen, we are going to see a comparison of bond market and bond returns across the globe in different geographies. And I'm paying attention closely in US dollar terms, so USD. So on the US aggregate bond index was down 5.93% for the quarter, which is an extraordinary quarter. But it fared well when you compare it against other economies. Japan, Germany, UK, it was ahead of everything here. And so it was down, but not down as much. And you can also, as investors, do things to mitigate that risk. So even though the global bond market was down, or the US bond market was down 5.93%, our bonds generally perform better than that for the quarter. We would take more defensive approaches, such as shorter duration and things like that. So I do want to speak a little bit about inflation in the next couple slides, but I want to point out ahead of time that when you're talking about inflation, it ties a lot to the longer term of the 30-year and the 10-year notes. So yeah, that's what I want to speak about coming up here is inflation. So that's the next topic we're going to cover. And the next slide is going to show some drastic price increases over the last year. This is a 12-month price change as of March, so March 2021 to March 2022. As we all know, gas prices have gone up an extraordinary amount in the last year due to both the economy reopening on the demand side, and also with the supply side, with the Russia and Ukraine crisis has cut out on oil supply. And it got up to as much as oil got up to as much as $125, $130 a barrel, but it's since come down a little bit. There's also some other things we're paying close attention to, and some of these higher numbers you're going to notice are more tied to more transitory things that we'll address on the next slide. But used car vehicles are tied to just supply issues as well. So they have a chip shortage that we're still fighting through. We expect that to continue for the next 12 months or so. So whenever you have used vehicles and production of vehicles cut short, it's going to increase used prices, new prices, and rental cars. They're all tied together. Hotel rooms and airfare are tied to the reopening economy. That's more of a natural thing. Food at home up 10%. A little bit of that is also transitory with supply issues coming out of Ukraine. Wheat exports are down right now. Wheat prices are way up. It filters into all kinds of food costs for people at home. Overall inflation, 8.5% in the yellow bar. That's the highest we've seen since early 1980s through a combination of just really strong demand and a really strong economy, and also the Federal Reserve being a little bit behind on the curve when it comes to increasing interest rates and controlling that demand that the economy has. So the Fed is paying attention to the higher numbers, but they're also really paying attention to some of the more permanent or sticky inflation numbers. As you can see, housing down below at 6.3%, which has to do with housing prices, and then rents at 4.5%, just a few spots below that. Those are some of the stickier portions of CPI or inflation that we follow. And we do expect it to moderate over time as the Federal Reserve tightens and slows the economy down through their efforts. It's going to really put pressure on prices. And we expect a lot of these to go down a little bit over the course of this year, but still maintain a little bit of an elevated level, maybe of around 3 to 4% over the next couple of years. So in the next slide, I want to talk a little bit about the supply chain issues that we're seeing. It's really extraordinary what you're seeing as the Fed has this Fed Global Supply Chain Pressure Index that's made up of components you see below. As you can see, it spiked right at COVID and has been going up steadily all the way through the end of last year and has come down some. And the components of that are Baltic Dry Index, which is the cost of shipping overseas, Harpex Index, which is the cost of chartering a ship to ship those goods, air freight price, which is prices of shipping things by air. This is all shipping so far. Then you have supplier delivery time, which is the time that it takes between orders received and then the orders shipped out to the client. And backlogs, which is just a list of, or the backlog of all orders that haven't been filled. It's pretty self-explanatory. Purchase stocks is how easy it is to secure inventory if you're any business that has you provide goods. So as you can see at the very bottom, purchase stocks, it's difficult to even buy some things if you're a business. So it affects all levels of the supply chain. But the good news is we're seeing the pressure index come down some, and we expect that to continue. We are, very bullish on things getting better in the supply chain. We think that it is going to get better, and it's going to help with the pricing problems that we're seeing. But that's a temporary thing. The Federal Reserve also has a really big job to do, and we're going to talk a little bit about them in the next slide. So this is a slide on the federal funds rate. This is the main tool that the Federal Reserve uses to either slow the economy or help the economy as needed. They act as a buffer. They have a dual mandate, which is price stability and full employment. And I don't know if you've heard this, but the job market is very tight. It's very easy to get a job if you're seeking one. There are 11 million open jobs. So unemployment isn't really much of a concern for the Federal Reserve right now. They're really focused on price pressures, and they're really paying attention to inflation. And they're a little bit behind on the curve. Earlier, we saw the yield curve come up and flatten in the earlier slide. And then the short end of the curve is the Fed trying to catch up to that. And we're expecting a lot of rate hikes in the short end this year. We're expecting, a hike to happen every meeting. There's 6 more meetings left. And we think that a couple of those meetings they're going to have 50 basis points or 0.5% increases. Normally it's 0.25%, but they're a little bit behind. So they're going to hike it 50 for 1 to 2 meetings this year. So by the end of this year, we're expecting a 2.25% on the short end of the yield curve. And by the end of next year, 3.25%. So rates will go up. And if you have any kind of adjustable loans that you have, it would be a good time to lock in those loans because we expect rates to continue to increase over time. But, rates are going to increase across all parts of the yield curve. But again, we're trying to be defensive when it comes to our investing approach. We like to stay short on our durations and our bond funds. We're exploring possibly shortening a little bit more, but we're trying to stick with high quality bonds and to really diversify your portfolio. We don't want to get out and buy really junky bonds that have really heavy correlations to stocks. For example, we like to buy super high quality, shorter duration bonds for this environment, and we're going to keep it that way for the foreseeable future.
Right, and that approach has worked in the first quarter for most of our client portfolios, where we've seen the bond market be down, but maybe our portfolios haven't been down as much in the fixed income space because we are trying to be defensive in that particular asset class.
Mhm.
Well, thanks, Chad. We will be focusing on our next topic of the day, which is Ukraine versus Russia, kind of international investing in general. This is a chart that just kind of compares significant events in the history of war and conflict and skirmishes all the way back to World War II, different types of invasions that we've seen, and all the way up to the most recent at the bottom here, Russia invades Ukraine. And so the 3 months prior and the 1 month later column, you can kind of see that the returns in those time periods are negative. We've actually come off the lows, as we've mentioned, even though we had a negative quarter overall, we were off the lows. Chad mentioned a negative 13% drop, and then most recently only down -7. But for the 1 month later return to kind of fill in this chart, we're up 5.4% 1 month later from the beginning of the invasion. As we're moving out across the chart here on different longer time periods, 3 months later, one year later, 3 years later, you can kind of just eyeball it and kind of start to see that a lot of the negative returns over longer time periods after a skirmish or an invasion turn positive. After 3 years, the only one that's been negative was when Germany invaded Poland, and that was kind of the start of World War II. Otherwise, when you look 3 years past the initial skirmish, it is positive returns. This is in the S&P 500, what we're seeing here. And so, and it really just reminds me, this whole idea is, it's terrible to see the images that we get to see in our computer feeds and the nightly news.
Yeah.
But there are opportunities that avail themselves to investors. And really, it just reminds me of the old adage that time in the markets is more important than timing the market. And what that means is that it's really hard to get in and out of the market at the right time. When you're a long-term investor, say you're planning for retirement or you're in retirement and you need your money to last you 5, 10, 15, 20 plus years, it's concerning, and we're doing our best to mitigate negative drops in the portfolio as best we can. But we want to be invested. We want to stay invested. We want to believe that the U.S. system, the global system, is going to still remain intact, and that the economy in the world is going to continue to grow. So we want to stay invested, even though it is scary, and this chart does show these different types of skirmishes. But we've seen uncertainty before, and surely we'll see it again in the future, and we will do our best to mitigate and rebalance portfolios when appropriate during these types of events. So this is just an interesting chart, and it just kind of teaches another lesson that we like to believe in. It's just global diversification and diversification in general. So what you're looking at is the VanEck Russia Investment Fund, ETF, Exchange Traded Fund, on a year-to-date chart. So prior to the invasion, right around up until late February, this basket of Russian companies was trading at about 25. Immediately after the invasion, you could see this chart just drop off the table here and end up down around 5 and then flatlined out. And basically what that's saying is that that market's liquid. You've lost over 80% of your asset value. It could be more when this fund starts trading again. Right now, it's not even trading at the moment. And so that teaches us kind of two lessons. The old don't put all your eggs in one basket, and don't be so invested in one particular country. And that also kind of is a term that we use. It's called home country bias, which means that you invest in what you know. You invest in your home country. We do want to invest some part of our portfolio here in the United States, or in this case, but you just don't want to put all eggs in one basket and be overly weighted to your home country. And this is a prime example of it. And it's just kind of a unique thing. And we didn't have direct exposure to Russian companies like this, but it is just kind of a warning that you want to be mindful of what you're investing in. just because there is a fund that you can access this particular country or this particular asset class. You really want to remain diversified in the approach. And so we're talking about home country bias. The United States represents about 60% of the world's companies in which you can invest. The other 40% or so is, of course, across the globe. And right now, we've seen this chart before, but it just really hammers home the point of not being all into one particular country. And the United States is currently valued on a price to earnings ratio, and that means how it's valued versus the earnings of the companies in that particular market at about 19, where countries across the globe are valued with the same metric at 13. And for an apples-to-apples comparison, that means that the companies around the globe, not based here in the United States, have a better entry. There's more. It's basically on sale, so to speak. You can kind of have the deals are maybe not so much in the S&P 500 with the technology companies doing so well in the past 3 years. We're really looking towards a global portfolio to help deliver returns over the next 10 years, over the next 5 and 10 years. So we want to be invested globally. And then, so that's kind of a chart showing on the left here, just valuations between price to earnings ratio. And this chart diving this way down to the right is showing that the S&P 500, the US stocks have become so much, have so much more value, or the affordability is a lot higher than it's been in the past. And right now, it's been the value is international. So on the right-hand side, that also proves the point. We have, with interest rates where they are today, I mean, Chad did mention them going up, but if you're just keeping your money in the bank, you're looking at inflation at over 8% over the past 12 months, where the bank's been paying you less than 1%. So you're losing purchasing power by keeping money in the bank. And so what we have to do is try to look for places to put that money to work and still get a good yield. And what the chart on the right is that comparing dividend-paying companies versus and abroad versus dividend-paying companies here in the S&P 500, and that there's better dividend yield to be had outside of the United States at this time. And so we still want to maintain this as part of our global portfolio and global asset allocation approach, even though there are conflicts, even though there are geopolitical events, and there's something that's in the news, just about daily of different things going on in the world. But there are opportunities and companies that service the globe we want to be invested in, and so we maintain that as a part of a global diversified strategy to ultimately meet your long-term goals into the future. Chad, can you just recap some of our points of optimism that we have here, and just the thought that yes, we are having some inflation, but overall it's still a pretty strong economy.
Yeah, this is our points of optimism. We're expecting strong corporate earnings to continue. Earnings season just kicked off last week, and there are some companies that are doing really well, especially banks. Banks tend to do really well in a rising rate environment because they're the lenders. And if you're an equity holder in a bank, then you've done pretty well compared to some other companies. Earnings have been great there. We expect that to continue. The next thing is that the economy's at full employment, as we mentioned before. Jobs are just really easy to come by. There's not many unemployment. There's a lot of demand in the economy. So it can take a beating, basically. The economy can take a little bit of, a little bit of a pullback and still be totally fine because we're just at such a low unemployment rate right now. And the next thing is rising interest rates are indicative of a strong economy. So generally speaking, when rates go up, that's a sign that the economy is doing well, and it is doing very well. Did you know that in COVID, rates really fell off a cliff and they became all-time lows in several categories, but rates are coming back up now. But that's indicative of a very strong economy. And the last thing is that economic growth is still on track to be positive for 2022. We do not expect a recession this year. We still think we're gonna we came off of a really strong year in GDP growth of 5.7% last year, and we think that the growth will be not quite as strong, but still positive. So that's a good sign. The next slide is about points of caution. These are not negative things. These are just things that we are cautious about. I would just like to say that overall we are positive on the economy and positive on the market right now. But with that said, the economy is still fighting supply chain issues that we covered earlier. We do expect those to subside a little bit, but for now they're still around and they're still lingering. Inflation is still here. It will continue to put pressure on portfolios and purchasing power. It's something that we're battling with and we'll have to battle with for a little bit. But the good thing about investing is you do get the yield, and with dividend paying stocks, you also get the growth in those dividends over time. So that also helps you combat inflation. The next thing is companies are feeling in the tight labor market. So with the earnings report, earnings are good, but they're having to pay up for labor. They're having to pay up to maintain their talent, and wages are going up as a side effect of that. And so it's cutting into margin, cutting into company margins, but not to the effect where it's going to really hurt earnings right now. And then the last thing is there are definitely lingering geopolitical concerns with Russia and Ukraine. That seems like it's going to continue for a while with no end in the near term anyways, but it's something that we're keeping an eye on and we'll continue to look at for with your portfolios.
Thanks, Chad. So I think overall, I think we are going to be, sticking to our long-term plan, looking for opportunities in the markets when they present themselves, and that the economy is still strong, despite the fact that we are seeing inflation, and sometimes it doesn't feel good to go to the grocery store or in the housing market, in the real estate market. Some of the pricing is growing very fast and very quickly, but the Fed is doing their best to kind of do what they're intended to do, which is to keep this economy moving forward, as well as having employment and people at their jobs, at their desk, and in the economy.
As a first-time home buyer, I'm definitely feeling the home prices right now.
Yes, absolutely. So we appreciate everyone's time today. We didn't have time to address any of your questions. Please fill out the post-webinar survey. We'd be happy to address any questions. If you're a current client, please let us know if there's anything else that we could cover for you or cover and explore amongst your personal portfolio. And if you are just thinking about joining us here at Tobias Financial Advisors, we always offer kind of a complimentary portfolio x-ray, where we will go in and kind of look at your current holdings and see how you're positioned and give you some feedback on how your outlook is inside your portfolio. And so with that, we do appreciate your time, and everyone stay safe, and we'll take care. We'll see you next time.
Thank you, everyone.